Usually when you listen in on a corporate earnings call, you expect a certain level of clarity.
Right. You want the numbers to just make sense.
Exactly. You want it to be like looking at the dashboard of your car. Like the speedometer says 60 miles an hour, so you're going 60.
The fuel gauge points to half. You have half a tank. It's safe.
Yeah, it's visible, it's categorized, and it gives you this sense of comfort. You know exactly where the business stands. But dial into an enterprise cybersecurity update, and suddenly it's totally smeared with mud. That clean dashboard is gone. You're trying to read this financial landscape that is just incredibly murky, and it's dominated by like this soup of acronyms.
Oh yeah, SASE, OT ASICs, east-west traffic.
Right. And if you're a retail investor listening to this, you're looking at a diagnostic nightmare if you don't already understand the underlying architecture of the industry.
You really are. The average investor logs onto one of these calls, and they just get hit with this barrage of deeply technical networking jargon, and it feels impenetrable.
It totally does.
They see revenue numbers that don't seem to match the physical reality of what the company actually builds. And you've got management teams talking about multi-year product cycles as if they're happening, overnight.
Which is exactly why we're here. Today, we are clearing the mud off that dashboard. We've got the Q2 2026 earnings call transcript from Fortinet Inc., ticker symbol FTNT.
That big one.
It's massive. We have the executive commentary, the Q&A session with Wall Street analysts, and all the raw financial data. And our mission for this deep dive is to extract the actionable signals from all that corporate noise so you listening right now can understand what the institutional investors are seeing.
And honestly, the sheer scale of the math on this call warrants a really forensic look.
It really does, because Fortinet didn't just beat expectations this quarter.
Yeah.
They kind of completely upended the current market narrative about enterprise hardware.
They really did. Let's get into the baseline numbers.
Yeah, let's start there. So total billings for the second quarter hit $2.37 billion, right? That's a 33% increase year over year. And total revenue was $2.05 billion. Which is up 26%. Now, for anyone listening who might be newer to evaluating a hybrid company, one that sells both physical hardware and software subscriptions.
Those two terms can be confusing.
Yeah. Revenue and billings, they sound like they should just be synonyms, but the distinction between them is literally everything in this sector.
It is the single most important accounting metric you can grasp when evaluating an enterprise tech stock.
Right, so break that down for us.
Okay, so revenue is a look at the present moment. It represents the money Fortinet actually recognizes on their income statement for a product delivered or a service rendered during that specific 3-month quarter.
So if they provide like a month of threat intelligence, they recognize a month of revenue.
Exactly. But billings are a look into the future.
Okay.
Billings represent the total amount actually invoiced to the customer right now, which includes both the recognized revenue for this quarter and the change in what is called deferred revenue.
Wait, let me frame deferred revenue with a simpler model for you listening, just to make sure we're all on the same page. Think about an annual gym membership.
Oh, that's a good one.
Right. You walk in on January 1st, you hand the gym a check for $1,200 for the whole year. The gym has your cash.
They put it right in the bank.
Yep. But from an accounting perspective, they haven't actually earned all of it yet. They've only earned $100 for January.
Right. And the remaining $1,100 goes onto their balance sheet as a liability.
Exactly. It's called deferred revenue because they still owe you 11 months of access. And as the year goes on, they slowly recognize that deferred revenue into actual revenue month by month.
And that is the exact mechanism happening here with Fortinet, just, scaled up to billions of dollars.
Right.
When a Fortune 500 company buys a physical Fortinet firewall for their data center, they do not just buy a piece of metal and silicon. They're buying a 3-year, maybe a 5-year subscription to the ongoing security services.
The threat intelligence updates, the technical support, all that stuff that runs on the box.
Exactly. Fortinet collects that massive multi-year cash payment up front. But legally, under accounting rules, they cannot call it revenue until they actually provide that ongoing digital service quarter by quarter.
So it sits there as deferred revenue.
Yes. Therefore, when you look at the dashboard and see billings growing at 33%, which remember is significantly faster than their 26% revenue growth.
It's like a crystal ball.
It really is. It tells you that there is a massive surging wave of future locked-in revenue coming down the pipe that hasn't even hit the income statement yet.
So the billings are screaming that this wave of money is locked in. But when you look at the internal composition of that revenue, you find this staggering divergence that really caught the market off guard.
The product versus service split.
Yeah, so product revenue, which means the physical hardware boxes, that grew by 52% to $773 million.
Which is a huge jump.
Huge. But service revenue, the software subscriptions, grew by only 14% to $1.27 billion.
Right.
I want to visualize this dynamic for you. Think about a modern smart home security system. You go to an electronics store, you buy the central hub, you buy half a dozen high-def cameras, the motion sensors, all of that.
Right. That's a steep one-time upfront cost.
Exactly. That is the hardware product. But those physical cameras are essentially expensive paperweights, unless you also pay the $30 monthly subscription to the company for cloud storage, real-time monitoring, mobile alerts.
The recurring fee.
Right. That monthly recurring fee is the service.
And this dynamic is precisely why a 52% growth in product revenue is the most bullish leading indicator you could possibly ask for when evaluating this company.
Because it's the foundation, right?
Exactly. If we look back at the transcript, Fortinet CFO Christiana Olgaard made a very specific point. She explicitly stated that they believe service revenue marked a trough back in the first quarter of 2026.
Like it hit the absolute bottom of its growth deceleration cycle.
Right, because you cannot sell the monthly monitoring subscription until you have successfully convinced the customer to bolt the cameras to their house.
You have to lay the physical foundation first.
Yeah, and the enterprise sales cycle is long, right? When an international bank or a global retailer decides to upgrade their network security, they don't just buy one box.
No, they're buying thousands of these physical FortiGate appliances.
Thousands. So this massive 52% spike in product deployments means tens of thousands of new physical units are currently being unboxed, racked into data centers, and configured all over the world.
Which is wild to think about.
Yeah.
And as those units are brought online over the next, 6 to 12 months?
Yeah, around there.
Every single one of them is going to require those ongoing software subscriptions to function properly.
Exactly. So the current 14% service revenue growth is just the trailing edge. The hardware explosion is the leading edge of a wedge that basically guarantees a future tailwind of high-margin recurring revenue.
In margins, that's where this story pivots from just a good sales quarter to an incredible operational quarter. Because, you could sell 1 billion physical units, but if the manufacturing costs and the customer support overhead just eat all your cash.
It doesn't help the investor at all.
Right. But Fortinet posted a 38% non-GAAP operating margin.
Which is a Q2 record for them.
A record. It's up nearly 5 full percentage points from the previous year. And to achieve a 38% margin on a business model that involves physically manufacturing, shipping, and supporting heavy hardware, that is incredibly rare.
It's almost unheard of in hardware.
Yeah, and free cash flow basically tripled year over year to $966 million in single quarter.
Nearly $1 billion in free cash flow.
So how do you scale physical operations that fast without bloat? My theory is that they must be automating an aggressive amount of their internal processes, because you don't get 38% margins just by negotiating cheaper shipping rates.
You definitely do not. And your theory aligns perfectly with what management detailed on the call. They are achieving these margins through radical operational efficiency, largely driven by artificial intelligence.
Okay, unpack that, because every company says they use AI now.
Right. We hear a lot of cybersecurity companies talk about selling AI to their customers to stop hackers. But Fortinet highlighted how they are turning AI inward.
Drinking their own champagne, so to speak.
Exactly. They are deploying AI internally to handle thousands of lower-level customer support and troubleshooting tickets without needing to aggressively expand their human call centers.
Oh, wow.
Yeah, and they're using AI models to optimize their global supply chain logistics, their inventory management. Even their engineering teams are using generative AI to write code and develop threat signatures faster.
So they are achieving massive economies of scale because their revenue is growing exponentially. But their internal headcount and support costs are growing at a much flatter, highly controlled rate.
That's exactly the formula.
Okay, but you see a 52% spike in physical hardware sales and record margins, and you really have to ask, What on earth are enterprises physically buying right now that they weren't buying a year ago?
That is the million-dollar question.
Right, because the prevailing narrative in the tech sector for the last 5 years has been that hardware is a legacy trap. The story was that everything is moving to the cloud, physical data centers are obsolete, and if you're building metal boxes, you're basically a dinosaur.
That was the accepted Wall Street narrative, yeah.
But CEO Ken G spent a significant portion of this earnings call talking about a new architectural concept that completely defies that narrative. He coined the term the SASE Firewall.
This is a fascinating evolution in how global networks are actually built, as opposed to how Silicon Valley marketing departments want them to be built.
Okay, so let's get into the weeds here. Explain the SASE Firewall to us.
So, to understand the SASE Firewall, we first need to understand the problem itself. SASE stands for Secure Access Service Edge. Over the past few years, especially during the big shift to remote work, the industry consensus was that the future of security was entirely cloud-based.
Right, the logic made sense, right?
Wait.
If your employees are working from home in 50 different cities, you don't want to force all of their internet traffic to travel back to a physical firewall, sitting in a corporate office in New York just to be inspected, and then send it back out to the internet.
No, it creates massive lag.
It's like forcing every package delivered in the United States to first pass through a sorting facility in Ohio before it can go to its final destination.
Yeah, it's wildly inefficient.
Inefficient and super frustrating for the user.
Exactly. So the cloud-only competitors introduced SASE. The idea was simple. Put the security in the cloud. The remote worker connects to a local cloud server. The traffic is inspected virtually, and it goes on its way.
And those cloud-only vendors basically declared that the physical firewall was dead.
They sure did. But Fortinet realized that this cloud-only approach ignores the complex physical reality of global enterprise data, so they bucked the trend.
How so?
They took traditional, local, physical network firewalls and integrated them seamlessly with cloud-based SaaS, running everything on a single, unified operating system called FortiOS.
Okay.
This hybrid approach, that is the SASE Firewall.
And the market is clearly validating this hybrid approach because Fortinet's unified SaaS billings grew 35% this quarter, pushing past a $2 billion annual run rate.
That's massive adoption.
Right. And adoption of their FortiSASE product in large enterprises hit 90%. And they highlighted a specific real-world contract on the call that I think perfectly illustrates why this is happening. They won a 7-figure deal with a global pharmaceutical company to secure 45,000 users.
Yeah, that's a great example.
Right. Why does a massive pharmaceutical company choose this hybrid hardware approach over a pure cloud SaaS competitor?
It really comes down to data sovereignty and the physical limitations of compliance. If a cloud-only SaaS ender pitches a global pharmaceutical company, their proposition is essentially, hey, route all of your employee traffic and data up to our multi-tenant cloud servers, and we will secure it there.
But consider what a pharma company actually does. They're dealing with incredibly sensitive clinical trial results.
Proprietary chemical compounds worth billions.
Yeah, genomic sequences, individualized patient health data. And they're operating in regions like the European Union that have really strict regulations like GDPR.
Exactly.
You legally cannot just beam a fringe citizen's medical data to a public cloud server sitting in Virginia.
You really can't. The data legally has to stay within the physical borders of the country, or sometimes even the specific building where it was generated.
So you need local data processing.
Right, to maintain patient privacy and regulatory compliance. This is a concept Fortinet refers to as sovereign SaaS. The pharmaceutical company looked at the cloud-only architecture and realized it was just a compliance nightmare.
So Fortinet won the deal because they were the only vendor offering a true hybrid reality.
Exactly. They can deploy a physical appliance, a SASE firewall, at the local clinical testing site in Paris to process and secure the highly sensitive patient data locally on the physical hardware.
Okay, I see.
Simultaneously, the remote sales rep traveling through airports can use the cloud-based SaaS to securely check their email. The enterprise gets the best of both worlds, all managed from a single, unified interface.
Because the physical location of the data matters just as much as the data itself. Like, the cloud is incredible for flexibility, but the physical world still exists, and national data laws still exist.
You absolutely need hardware at the edge of the network.
Which actually brings us to a data point from this transcript that frankly stopped me in my tracks. It is a technological milestone.
Oh, I know which one you're going to mention.
Yeah, management noted that machine-to-machine internet traffic has officially surpassed human traffic.
It is a fundamental shift in the architecture of the internet itself.
I mean, just wrap your head around that for a second. More data is now being generated, transmitted, and processed by autonomous AI agents talking to other AI agents and servers talking to servers than by human beings watching streaming video, sending emails, or browsing the web.
It's mind-blowing.
The machines are now the primary occupants of the internet. So what does this actually mean for the physical data centers that house all of this artificial intelligence?
Well, to understand the impact, we have to look at how data moves. Imagine a traditional data center as a walled city. Historically, security focused almost entirely on the gates to the city.
Okay.
Traffic flowing in from the outside world, from humans on the internet, and traffic flowing back out. In network engineering, this is called north-south traffic. You put one massive, powerful firewall at the perimeter to inspect everyone entering and leaving.
Right, but AI workloads completely break this model, don't they?
They completely shatter it. When you are training a generative large language model, you aren't just downloading data from the internet. You have thousands of individual graphic processing units, GPUs, inside the data center that need to talk to each other simultaneously.
So they're exchanging terabytes of parameters and data sets back and forth internally, like at the speed of light.
Exactly.
So north-south is me connecting to the city from the highway, but the AI workload is entirely internal. It's like thousands of delivery trucks speeding back and forth across the side streets between buildings inside the city walls.
That is a perfect way to visualize it. And that internal lateral movement is called east-west traffic.
Got it.
AI workloads generate absolutely colossal amounts of east-west traffic. Now, if you are operating an AI data center, you cannot just assume everything inside the city walls is safe.
Right, because if a bad actor or a piece of malware manages to breach just one single server and you have no internal checkpoints on those side streets,
they can move laterally east-west and compromise the entire cluster. They could steal the proprietary AI model, which, might be worth hundreds of millions of dollars.
Wow.
V4, you must segment the network internally. You need robust, high-speed security checkpoints positioned physically between the server racks.
But the challenge there is latency, right? If you put a security checkpoint on every side street, you create traffic jams. And if the AI training cluster has to pause for even a microsecond while a software firewall inspects a packet of data, that latency cascades across thousands of GPUs.
Yes.
It ruins the efficiency of the training run and wastes incredible amounts of money.
Which is exactly why Fortinet is dominating this specific niche right now. Software firewalls simply cannot process east-west AI traffic fast enough.
Okay.
On the call, Fortinet highlighted securing an 8-figure deal, so a contract worth over $10 million, with a neo-cloud provider specifically to secure generative AI workloads.
And this built on a 7-figure deal they secured with the same customer in the previous quarter, right?
Exactly. These neo-cloud providers are specialized data center operators building custom infrastructure purely for AI. They are buying Fortinet's highest-end, heavy-duty physical hardware to act as those internal checkpoints because Fortinet hardware can inspect that east-west traffic at blistering speeds without introducing the latency that kills AI training.
They're essentially building the high-speed toll booths for the AI infrastructure.
Yes.
It's fascinating because it's a completely different security paradigm than, say, protecting an employee's laptop.
A whole different ballgame.
Yeah. And speaking of securing physical infrastructure, the transcript revealed another massive growth engine that sounds incredibly niche but is expanding rapidly. Fortinet flagged that their billings for operational technology, or OT, increased by over 55%.
That's a huge number.
Right. Now, for you listening, we need to draw a hard line between IT and OT because a hack in one means you lose your data, but a hack in the other means you lose physical safety.
It is a critical distinction. IT, or information technology, is the digital realm. It's your corporate email server, your laptop, your customer database.
Right.
OT, operational technology, is the digital interface that controls the physical world. It is the software and hardware that commands the robotic welding arms on an automotive assembly line.
Or the system that regulates the speed of the massive turbines in a hydroelectric dam.
Yes, or the technology that opens and closes the chemical purification valves at a municipal water treatment plant.
And historically, these OT systems were never considered a major cybersecurity risk because they were what's called air-gapped.
Right. They were physically isolated. The computer controlling the water valve was not connected to the internet, and it wasn't connected to the corporate email server.
So the only way to hack it was to physically walk into the plant with a floppy disk or a USB drive, like we saw with the Stuxnet virus years ago.
Exactly. But today, the air gap is dead.
Right, because of the push for efficiency, predictive maintenance, remote monitoring industrial companies are connecting everything to the central network.
The plant manager wants to check the turbine speed from their smartphone while they're at home.
Yeah, but the moment you connect a 30-year-old water valve controller to the modern internet, you expose critical physical infrastructure to global cyber threats.
And the major cybersecurity players, the ones obsessed with cloud software, they haven't built solutions for this environment. A water treatment plant or an offshore oil rig doesn't have a pristine, climate-controlled data center with perfect cooling to run standard server racks.
No, definitely not. And as management noted on the call, Fortinet is practically the only major network security vendor that has been investing heavily in OT for years.
Yeah, they actually manufacture ruggedized physical firewalls. These are heavily fortified hardware appliances built to withstand extreme temperatures, vibrations, and dust.
So they can sit on a dirty factory floor or an oil rig and provide enterprise-grade security. And the demand signal here is massive. They mentioned a 7-figure deal with a major utility company for a communications modernization project, deploying Fortinet hardware across thousands of distributed field locations. And there's a geopolitical macro environment accelerating this too, which CFO Christiana Olgaard specifically called out. She pointed to strict new European regulations.
Right, because when geopolitical tensions escalate, the primary target for a nation-state cyber attack is not necessarily a company's database, it is an adversary's critical infrastructure.
Shutting down a power grid or crippling a port facility creates immediate chaos.
Exactly. Governments have realized this is a glaring national security vulnerability. In the European Union, they've passed stringent new directives, like the NIS2 directive, that essentially mandate that utility companies and critical infrastructure operators modernize their cybersecurity to highly resilient levels.
And if they fail to comply?
Oh, corporate executives can be held personally liable, and the companies face catastrophic fines. These utility companies are essentially being forced by law to buy exactly what Fortinet has spent the last decade building.
Okay, I want to pause here and challenge the underlying premise of everything we've discussed so far. We have talked about sovereign SASE at clinical trial sites. We've talked about high-speed checkpoints for AI, east-west traffic, and we've talked about ruggedized firewalls for oil rigs. All of this relies heavily on Fortinet manufacturing specialized physical hardware.
Yes, it does.
But if you listen to the earnings calls of their massive competitors, companies like Palo Alto Networks and CrowdStrike, they tell Wall Street that hardware is a dead end. They argue that the future is pure, elegant software running on standard cloud servers. So why on earth is Fortinet still dumping billions of dollars in R&D into designing and manufacturing custom physical microchips? They wouldn't stop talking about their proprietary silicon, the ASIC.
Right.
If the rest of the industry is writing software, why is Fortinet building chips?
It is the ultimate contrarian bet in the entire cybersecurity sector, and it forms the absolute bedrock of their competitive moat.
Really? How so?
To understand why they do it, we have to look at the physics of how computers process data.
No.
If you are a software-centric competitor like Palo Alto or CrowdStrike, you run your security algorithms on general-purpose CPU central processing units made by Intel or AMD.
Okay.
A CPU is a brilliant piece of engineering. It is designed to be highly versatile. It can run a spreadsheet, render a video, browse the web, and run a software firewall.
I like to think of a general-purpose CPU as the highly trained executive chef in a commercial kitchen. The chef is incredibly versatile. They can bake a delicate souffle, they can butcher a side of beef, they can whip up a complex sauce.
Right.
But because they are doing a million different complex tasks, it takes their time. If you suddenly ask that executive chef to toast 10,000 slices of bread in 1 minute, they are going to completely fail. The kitchen will just grind to a halt.
That is a brilliant analogy. When you throw the astronomical volume of data generated by a modern AI data center at a general-purpose CPU, the CPU chokes. It is too versatile to be fast at that one specific task.
It's trying to make a souffle when you just need toast.
Exactly. If a CPU tries to inspect terabytes of AI east-west traffic for malicious code, the network latency spikes and the AI training fails. Fortinet's founder, Ken Xie, recognized this fundamental physical limitation over 2 decades ago. He realized that to truly secure massive networks without slowing them down, you cannot rely on the executive chef.
You need to build the industrial toaster.
Precisely. You need a machine that does exactly one thing, but does it at a scale and speed that defies belief.
And that's what the ASIC is.
Yes. ASIC stands for Application-Specific Integrated Circuit. Fortinet designs their own custom microchips entirely in-house. These chips cannot run a spreadsheet or browse the web. They are physically hardwired at the silicon level to do exactly one thing: process security networking algorithms at the speed of light.
And Fortinet highlighted their ongoing deep manufacturing partnership with Intel to continue fabricating these chips. Because they designed the silicon themselves, they possess a 10-year research and development moat that software companies simply cannot replicate overnight.
They can't. And the economic implications of that chip are profound, especially right now, because AI data centers are currently facing a massive crisis regarding power consumption.
Right, they are starving for electricity.
Yeah, and that is the secondary benefit of the ASIC that makes it a trump card in the AI era. Because the ASIC is highly specialized, it requires vastly less electricity to operate than a general-purpose CPU trying to do the same task.
So Fortinet's custom hardware delivers a price-to-performance ratio and an energy efficiency ratio that software-only competitors physically cannot match.
Right. They can process data 10 times faster at a fraction of the power consumption and a fraction of the cooling cost. When you are a neo-cloud provider building an AI cluster, every watt of electricity saved on security is a watt you can redirect to the GPUs for training.
So if you possess a custom microchip that solves the latency and power problems of the AI revolution problems your competitors can't solve because they rely on software, you suddenly have massive pricing power.
You absolutely do.
Which leads us directly to management's financial guidance for the rest of 2026. Because if we look at the broader technology landscape right now, it is fairly grim. A lot of enterprise software companies are guiding down. They are showing caution, citing macroeconomic headwinds.
But Fortinet did the exact opposite. They are raising the bar across the board, which is a massive flex of confidence in this specific macro environment.
They raise guidance on virtually every metric. They project Q3 billings between $2.25 billion and $2.35 billion, which represents a 27% growth rate at the midpoint.
Yes.
And they raise their full year 2026 revenue guidance to a range between $8.02 billion and $8.18 billion. While other tech executives are on their calls blaming high interest rates or elongated sales cycles for their soft numbers, Fortinet is effectively saying, our demand is so inelastic and our hardware is so thoroughly baked into the physical infrastructure of the future that we're going to cruise past our previous estimates.
But the nuance of how they're achieving that revenue growth is critical. During the Q&A session with Wall Street analysts, one analyst drilled down on the mechanics of their pricing. The question essentially probed whether this revenue growth was purely organic demand or if Fortinet was just artificially padding their numbers by jacking up prices on their existing customers to combat inflation.
Right, because CFO Christiana Olgard was very transparent that there are high single-digit pricing impacts baked into their revenue projections for the second half of the year. So are they just squeezing their customers because they know they have a monopoly on these ASICs?
Well, it's actually a dynamic pricing model based on supply chain realities. Because Fortinet actually manufactures physical goods, they are highly exposed to fluctuating input costs, particularly the commodity price of memory chips and raw materials.
Okay, that makes sense.
To maintain that pristine 38% operating margin we talked about, they adjust their hardware prices in real time based on those input costs.
But wait, if I am a distributor, a channel partner, whose job is to buy Fortinet gear and resell it to hospitals and banks, and I know Fortinet is about to raise prices because memory chips got more expensive, wouldn't I just buy a massive amount of inventory today and hoard it in my warehouse?
To sell it at a premium later.
Yeah, I could buy it cheap, wait for the price hike, and then sell it at a premium.
So that is a massive risk in hardware sales, known as channel stuffing. It creates a mirage. Right. The manufacturer looks like they had an amazing quarter because they sold tons of boxes to distributors, but those boxes are just collecting dust in a warehouse. They haven't actually been deployed by an end user.
Exactly.
But Ken Xie addressed this directly. Fortinet prevents this through 2 mechanisms. First, their dynamic pricing goes both ways. If the cost of memory chips goes down globally, Fortinet lowers the price of their firewalls in real time.
Oh, interesting.
Because the channel partners know the price is fluid, there is zero incentive for them to hoard excess inventory to beat a price hike. They might end up stuck with overpriced gear if input costs drop.
That's smart. And the second mechanism is even more aggressive, right? They have a strict contractual policy regarding the software subscriptions.
Exactly. Fortinet starts charging the channel partner for the ongoing support and software subscriptions 90 days after the hardware ships from the factory, regardless of whether the partner has actually managed to resell it to an end user yet.
Wow. So no distributor is going to hoard thousands of firewalls in a warehouse if they're going to start getting billed for the software subscriptions on those idle boxes 3 months later.
Not a chance. This policy entirely eliminates channel stuffing. It guarantees to investors that every single box Fortinet reports as sold represents true, immediate end-user demand. That 52% product growth is entirely organic.
That is a vital reality check for anyone looking at the stock. The growth isn't a supply chain accounting trick. And speaking of the stock, management isn't just expressing confidence through their vocal guidance. They're putting hundreds of millions of dollars on the barrelhead.
The buybacks.
Yes. They reported repurchasing 1.9 million shares in Q2 for $146 million. If you look at the year-to-date figures, they've bought back over 12 million shares at an average price of around $78. And they still have $756 million remaining in their authorized buyback tank.
The mechanics of this buyback summarize the financial health of the entire operation. Management is generating nearly $1 billion in free cash flow every 90 days, and they are using a significant portion of that cash to aggressively eat their own float.
Which is a huge signal to the market.
It really is. When a company boasting 38% operating margins and accelerating hardware deployment uses its own cash to buy its stock at $78 a share, the message to the market is unequivocal. They believe the intrinsic long-term value of the business is significantly higher than what Wall Street is currently pricing in, and they have the balance sheet to capitalize on that disconnect.
Okay, so we've journeyed from the raw billing metrics through the physical reality of sovereign SaaS and AI east-west traffic into the silicon architecture of the FortiASIC, and finally into the aggressive financial guidance. When you synthesize all of this data, what is the actionable bottom line for the listener managing their own portfolio?
The transcript flashes a highly robust bullish signal for anyone evaluating the stock right now. And the core of this bullish thesis rests on a major shift in enterprise buying behavior.
Consolidation.
Historically, the cybersecurity market has been wildly fragmented. A chief information security officer at a Fortune 500 company would buy a perimeter firewall from vendor A, endpoint protection from vendor B, cloud SASE from vendor C, and network analytics from vendor D.
They end up with 50 different security dashboards that don't communicate with each other, requiring 50 different specialized engineers to monitor them. It's incredibly expensive, and frankly, it's inherently insecure because the gaps between those disconnected systems are exactly where the hackers slip through.
Precisely. The complexity has become unsustainable. What we are seeing in the massive 52% hardware deployment and the 35% SASE growth is undeniable proof that the enterprise market is consolidating around Fortinet as a primary platform.
They are no longer viewed simply as the company that sells the firewall box.
No, they are a consolidated platform provider. Customers are buying across all of Fortinet's pillars, secure networking, unified SaaS, and AI security operations to save money, simplify their engineering requirements, and close the security gaps. Fortinet is proving they can dominate both the physical edge and the cloud simultaneously.
But, no investment thesis is bulletproof. If you're listening to this and considering the stock, you have to look for the cracks in the armor. What is the fundamental risk to this bullish consolidation narrative? Like, what metric could derail this momentum over the next 6 to 12 months?
The single most critical risk metric to watch is the conversion rate of this hardware surge into recurring software revenue. You have to respect the law of large numbers. Maintaining a 52% product growth rate long-term is essentially defying corporate gravity.
It's nearly impossible.
It is. Eventually, the hardware refresh cycle will cool down. Everyone who desperately needs a new high-speed toll booth for their AI data center will have purchased one. Investors must model for the reality that the product growth rate will eventually normalize back down to earth.
which means the entire narrative hinges on execution on the back end.
Exactly. The critical period will be the third and fourth quarters. Fortinet must prove to the market that they are successfully activating the software subscriptions on all of these newly deployed boxes.
Because they promised that service revenue troughed at 14% and will accelerate.
Right. If product sales slow down in Q4 and the service revenue does not simultaneously accelerate to pick up the slack and maintain the overall billing growth, the platform thesis fractures. Wall Street is currently buying the stock based on the promise of tomorrow's high-margin software subscriptions. Fortinet has to actually collect on that promise.
That is the perfect grounded reality check to balance the enthusiasm. So to bring this massive deep dive home, let's look at the 4 architectural pillars we uncovered today. First, we saw a reality-altering product growth surge of 52%, proving that in the enterprise world, physical hardware is absolutely not dead. It is the prerequisite for future software revenue.
Exactly.
Second, we dissected the 10-year research and development mode of the custom Fortinet ASIC microchip and how it perfectly positions the company to secure the high-speed east-west traffic of AI data centers and the rugged physical realities of operational technology.
The industrial toaster.
The industrial toaster, yes. Third, we watch management flex supreme financial confidence by raising full-year guidance and executing aggressive stock buybacks fueled by near-record operating margins. And finally, we established a bullish long-term thesis built on the enterprise, desperately seeking to consolidate their security architecture onto a single, unified platform.
It is a phenomenal confluence of data points. You have a company operating at the exact intersection of several massive macroeconomic trends. The explosion of generative AI, the modernization of critical infrastructure, and the necessity of data sovereignty.
Which leaves me with a final, somewhat provocative thought for you to ponder as you look at your own portfolio. We started this deep dive talking about trying to clean the mud off the corporate dashboard, trying to get a clear diagnostic look at the machinery. Well, the diagnostic read on Fortinet shows a company that is quietly building the literal bone structure of the new internet. If machine-to-machine traffic is now officially the dominant force on the global network, driven by autonomous AI agents and server clusters, and Fortinet is manufacturing the exact physical toll booths, the specialized silicon chips, and the hybrid SASE firewalls that are required to secure, process, and regulate every packet of that traffic without causing a catastrophic delay. Are we still just looking at a traditional cybersecurity company? Or are we looking at the future central nervous system of the entire global AI economy? Something to think about. Thanks for joining us on this deep dive.